Welcome back to the Financial Symmetry Podcast. Chad Smith and Mike Eklund here with you this week, talking through a piece of the financial planning process that we focus on from time to time on the show. Everyone is always concerned about their investments, right? Their portfolio and how that is supporting their financial plan. We don't talk about it every episode because it's not always the most important part of the financial planning journey that you're on to build wealth and reach that ideal retirement. But it is an important piece, and you want to understand where things are and where opportunities might lie in your portfolio and the decisions that you're making around your portfolio. So Mike Eklund put together some slides here that we're going to walk through. If you're just listening to the podcast, we'll have a support video that shows, and you can go look at some of the charts that we're going to walk through, because it's always interesting to see how charts support different decision-making pieces in your portfolio. But Mike, you want to kick us off?
Yeah, thanks, Chad. I'm glad to be back on the podcast. This is an exciting year in 2024. We actually do a quarterly market update that we post to our website. It's not always on the podcast, but we do have it on the website if you want to look at previous quarters and our feedback. But really, we want to take a look at what happened in 2024 and what to think going forward in 2025. But before we do that, just as a reminder, we are not providing investment advice here. If you are a financial symmetry client and you have questions about your portfolio, please contact your advisory team. If you're not a financial symmetry client and you want to learn more about our investment process, you can obviously contact us as well, and we're happy to walk through how we could help you. So that is there. We'll move forward to the next slide and talk a little bit what happened last year and what's been happening over the last 5 and 10 years as well. So a lot like 2023, 2024 was a very strong year for the U.S. stock market. It was up almost 24%. The international markets were up as well, not nearly as much, between 5 to 8%. And then bonds, U.S. bonds were up a little over 1%. So as you look at that numbers as well as the 5 and 10 year performance, you obviously can see the U.S. stock market has done extremely well the last 5 and 10 years. So you're probably thinking, that sounds great. That's where we should invest all my money. Right, Chad?
Yeah, that's right. We've had 2 great years, right, in a row. So we're going to talk a little bit about, what to expect in terms of good years and bad years, and then also, some of the numbers on the page in terms of international performance as well as bonds. You're saying, well, why do I even own that? We have a couple of slides there talking about kind of what we've seen historically and what maybe happens with those investments going forward. So, and some of the concerns that we'll have, or I guess requests, right? It might be, we've seen large tech doing very well. We hear about a lot of these stocks. We're talking about a lot of these different stocks in conversations we're having, and just wanting to understand, like, what type of return should we even expect long term? Because over 20% the last few years is looking pretty good for the U.S. growth area, right?
It's great. I mean, I think for those that have invested with financial symmetry, you've benefited from that, as well as unfortunately some of the other holdings that haven't done as well, and that's diversification. If you were smart enough, 10 years ago to put all your money in large tech, that is great. There is a reminder that during the 2000s, though, tech stocks actually lost 30% for the whole decade. So as strong as that market or that part of the market has done, there have been time periods, and that's 10 years. Think about investing on January 1st, 2000, $1 million, and waking up 10 years later and only having $700,000 in your account. So it's when you talk about 20% per year, that is definitely not 20% per year. But what this graph shows is that over the long term, about the last 100 years, the U.S. stock market has averaged about 10% annualized return. But it rarely returns 10%. Only 6 years of the last approximately 100 years has actually been around 10%. Most of the times, like the last couple of years, it's in the mid 20%. And then we saw in 2022, we were down about 20%. So you have these ups and downs. So keep in mind, that is why we always like to say investing in stocks is like a roller coaster. There's going to be the ups and downs, but the key part is you got to stay in your seat.
Yeah, and it always kind of feels like in many situations you want to do something, right? You want to tweak it to just make it a little bit better. You got the recency bias that really impacts a lot of your opinions or feelings, and the emotions can get involved and make you feel like you got to change something. But this is an interesting one, right? As we're moving into the diversification idea, because so many of us want to have the most in our portfolio of what is doing well, or has done well. It makes us feel like that's what's going to do well in the future. But I think I love these types of charts because it really breaks down how different things truly can be across the world, right?
Yeah, I mean, it's a very colorful chart, a graph to begin with, and that is by plan. Don't try to look at every single line or box. That's not the priority here. The goal of this page to really provide to individuals is to show you how much country returns by country, U.S., Denmark, Sweden, Norway, UK, change year to year. So right now we don't have this updated yet for 2024, but it's likely going to have U.S. near the top, not the top, but near the top, which it also did in 2023, which is great, which as you saw before there, it's had some very strong returns. But if you go back, let's just say to 2004, it was the second to the bottom. 2006, the U.S. was the second to the bottom. We fast forward to 2017, it's the third or fourth to the bottom. So the key thing we're trying to take away here is, although diversification can be painful, it is your best friend, because there are time periods, as you see here, there are years where the U.S. stocks are one of the bottom, and there are years that are one of the top. And the only way to know which one is the top is to invest in all of them.
Mm-hmm. And often avoiding mistakes or catastrophic mistakes in your investment strategy can be a helpful long-term approach, right? But it's very difficult to ignore the things that are dominating the news cycle or the conversations with family and friends. So you get into these areas here, and this is kind of interesting to look at how things have done, right?
Exactly. We don't talk a lot about kind of the price you're paying for a stock or for a stock market or technology stocks. But the reality is, when you buy a company or a stock, you are there's a price you're paying, what's called a price earnings ratio. So you're paying a multiple of what the earnings that company generates. Think about, for example, if analogy I would use is, let's say you go to the store and you're buying a shirt and it's $50, and you go back, let's say a year from now, to buy the same shirt and it's $75. What has happened? The shirt, it's the same shirt, same quality. Is in that situation, the valuation has gone up, and in this situation, for example, Nvidia, the tech sector, the price you're paying for the same companies for that same dollar of earnings now is much more expensive. So, for example, Nvidia has grown dramatically, and if it continues to grow, that's great. But you're paying $52 for every dollar of earnings, versus, for example, large companies that are value companies, like maybe like a Coca-Cola or a 3M or something. You're paying $15 for every dollar of earnings. Mm-hmm. Now, in a year-to-year basis, we'll see in a second, doesn't really make that much a difference. But over a longer time period, the higher the price you pay, as a lot of people who purchased Cisco systems back in 1999 found out, the lower potentially that future return will be.
Yeah, and when you're actually shopping, in your example, it is intuitive to us to make that decision. But when you're investing, it's not. Right? It's almost counterintuitive to want to buy things that haven't done so well, but those are the things that are cheap, right? And can have higher expected returns going forward. So if you expand it to talk about the global equity returns, we've got this graph to kind of talk through how that looks, right? And could look.
Yeah, this is more just I won't say a history lesson, but a class on, when you invest in a company or a stock, where does that return come from? It comes from, you get a dividend, which is great. So they have earnings and they distribute some of that earnings to the shareholders, and you get a dividend, and some, so that could be 2-3% depending on the company or the market you invest in. There's earnings growth. Obviously it's growing faster. That's great. If there is growth, you're going to get some benefit from that growth. The third component, which is Jack Bogle, the former founder of Vanguard, I always like to say is the speculative return, is the change in the price you're paying. So what we showed on the previous page is the price you're paying for a certain type of companies and stocks today is much more expensive. For example, U.S. large stocks are much more expensive today than international stocks or U.S. small stocks or U.S. value stocks. And that's because of that multiple expansion. So, for example, this chart from JPMorgan, if you look at the 2024 year, what happened? The U.S. stock market was up about 25%. And you see from that grayish line, a lot of that 25% return was just people willing to pay a lot more for those stocks. We saw the same thing in China. So China actually had a good, almost 20% return last year. Part of that return was people willing to pay more for it. Mm-hmm. Now, on the flip side, if we look back, if you look at the 15-year chart, Japan over the last 15 years have actually had higher earnings growth than the U.S. I'll say it one more time. Japan has actually had higher earnings growth than the U.S. over the last 15 years. But people want to pay less for it than they would 15 years ago, which is why the returns are lower. Whereas in the U.S., people are paying more for that dollar of earnings. So, and we'll get to in a slide in a second. What does that mean? You're saying, well, how does that impact me? Is, as I mentioned earlier, typically the higher the price, the lower the future return.
Right. And that's when you get into the different regions here of valuations, right? And how that could impact or what that has meant for future returns going forward.
Exactly. And I will say the first to say, and we've seen it the last 5 years or so, valuations are a horrible timing indicator. They tell you nothing about what's going to happen in the short term. I want to start with that. But what this graph shows as well is that, currently the price people are paying for something called the price to the book ratio, which is similar to price to earnings. What they're paying for U.S. stocks is now at an all-time record versus what they're paying for international stocks, the spread between the two. So historically, when we've seen a wide spread like that, using one market, for example, in 1999, people were paying a high price for U.S. stocks versus international stocks. And what happened in the next 10 years? International stocks outperformed. Now, it wasn't a straight line, but you can see that valuation gap does tend to close, or people will call mean revert over time.
Yep. And the timing, like you said, expensive things can continue to become more expensive, right? That's some of the things that you can forget or not consider when you're investing because you've seen those high returns, and it makes you want to try to double down sometimes on that, or at least stay invested in those areas.
And that's a great point, Chad. That first bullet tries to follow that comment that virtually no portfolio strategy more reliably produces worse returns than performance chasing. Everyone, has something called FOMO. If you haven't heard about it, it's very common. Read the press. It's called the fear of missing out. And today you might hear about what Bitcoin is very popular. We're not going to talk about that today. But if you're seeing those returns and figure out, well, I don't want to miss out on that. I want to chase what has done really well. Now, the negative part of that is historically that's been a really bad investment strategy.
Yes, and that can apply to our next topic here, right? With international stocks, and that's something that's been out of favor for some time, and one that can feel, well, there's been many headlines like, why should I even consider investing internationally anymore, right? The U.S. seems to have all the ingenuity, all the growth opportunities, so why should we even have foreign stocks in our portfolio?
That's a great question, Chad. And you probably can see a theme to our podcast and our slide deck this quarter, and that obviously the feedback from clients, from everyone else is if just buying large tech growth companies in the U.S. seems like the only way to invest because they've been great performers. The concern is they're now priced for perfection, as we saw, for example, in the late 90s with tech stocks. We saw with financial stocks. You believe it? You remember in 2005 and 2006 and 2007, Merrill Lynch and Bank of America and Citibank. That was the tech stocks of today. There's always a hot area of the market that gets overpriced, and then the future returns are much lower. But what we're trying to show here, and this was a blog post that Financial Symmetry had in the fourth quarter, is that although the U.S. has outperformed international recently, you see by the dark blue line and the teal line, there's times when the teal line is higher than the blue line, which means international stocks, or sorry, the blue line is higher than the teal line when international stocks outperform, and vice versa. And they tend to go in cycles. There's typically a 5 to 10 year time period where one market outperforms the other, and then it flips back where the other market outperforms. So does that mean that international markets can outperform in the next 5 years? I don't know, but I just don't want to be in a situation where I put all my eggs in one basket and miss out on the growth of the global economy.
Yes, and you can take a look at that blog. We have it linked. We'll have it linked in the show notes and the address here on the slide if you're watching on YouTube. So, it's interesting to think through because so much of our FOMO dominates these decisions, but the speed at which things can change in the market, and then you look back and say, well, I didn't even realize that was happening, right? Because many times it doesn't dominate the news until the performance is there. So that's another reason why you want to stay diversified, because you don't know when things are going to shift, and they can shift quickly. On the stock side for sure, and sometimes on this side as well, as we're moving to our next topic, right, on bonds. Because I think many of the conversations we would have when interest rates were rising, there was a strong desire to put more in bank accounts, right? CDs, high yield savings accounts, because it was certain. You could see the interest applying to your bank account monthly. It felt really good, right? To see that and know that it's guaranteed. With bonds, it's a little more confusing because you don't necessarily see that immediately, but man, there could be some opportunity there in bonds that you might look back after 5 or 10 years and be pretty happy with compared to your cash, right?
Exactly. I mean, bonds are kind of the unloved category. Few people call and want to talk about bonds, but I like to say, bonds are boring for a reason. And we'll talk about it in a second. They have a purpose in our portfolio as well. But we talk about stock returns. Stock returns are very difficult to predict. Now, there are some longer term indicators, like I said, valuation, which are pretty good at forecasting future returns. But bonds are kind of the opposite. What the yield you're getting today, as this graph shows as well, is a pretty good indicator of what the return you're going to have over the next 5 years. So this is the U.S. Aggregate Bond Index. And based upon the kind of the yield today, as of the end of December, about 5%, you're probably going to end up with about 5% 5 years from now. So the good thing is it's a 88% R squared, which is the correlation. It's a high likelihood of that return, as you see by the graph here. You can see it's very tightly correlated to the line. So on the bond side, that's actually very helpful in trying to predict how much money you'll need in the future for certain events, or for our clients for their spending goals over the next few years. We can want to keep that money into bonds because it's much easier to predict what's going to happen.
And then there's a lot of attention, because interest rates are correlated with bond returns, and the Fed, a lot of conversation about the Fed, right? And trying to predict what the Fed's going to do and how's that going to impact my investment portfolio. What moves should we make as a result of what we think the Fed might do? Let's talk about the uncertainty involved there. Yeah,
this is a graph. It's very helpful from JPMorgan that shows the federal funds rate over the last 20 or 30 years or so, and you can see it obviously goes ups and downs and ups and downs, and that's kind of the reason why we talk about this after bonds, is where that 5% is pretty much the return you're expected to get over the next 5 years. With cash, that number can change day to day, year to year, as we saw after the financial crisis in 2007. Cash rates went from about 5% to zero within, I felt like, minutes, but it was a few months. Today, the market is expecting that rates will drop to about 3.9% into this year. This is federal funds rate or cash kind of rate that provided, and then down to 3.4%. So there is expected they'll have a drop of about 50 basis points per year. So keep that in mind, where the bond, if you have a little more time on your side, it's potentially a higher return. Where the cash, the yield you're getting in the bank account sounds great, but when they start reducing this federal funds rate, the interest rate in your bank account will go down as well.
Yeah, there's reinvestment rate risk with that,
exactly,
right?
Yes.
That's a topic that may not be discussed as much, but so some people would argue, okay, well, I'll lock in a CD, right? And then I'm good for a year or two. But at the end of that time frame, you still have a decision to make, and then what will you be able to invest in at that point with what the opportunities look like at that point could be very different, right? So that's some of what you have to consider when you're dealing with decisions on things that are somewhat guaranteed, right, in the short run and easy to access. So there's always risk if you're looking for higher return is the key there.
Exactly, yes.
So how are our experts thinking, right?
We just went through this whole thing telling you that you can't predict the future, and now we're going to have a slide on future predictions. So we're talking against ourselves here. But we thought we'd just provide you some context of, okay, some folks that are pretty knowledgeable and had some pretty good long-term track record, like BlackRock and JPMorgan, Schwab, and Vanguard. They do come out with forecasts. So as a reminder, forecasts are, no one has a crystal ball, but based upon history, their research, fundamentals, they're taking a look at not really over the next year, but over the next 10 years or so, how they think, for example, U.S. stocks versus international stocks and versus bonds will perform. So a little bit of a colorful graph there, but the key takeaway for me is all of these quote unquote experts expect the international markets to outperform the U.S. market. So my first takeaway is, how can that be possible, Chad? Because if we looked at that first page, the U.S. stock market has outperformed everything in the last 10 years. So why would we want to invest anything but U.S. stocks right now?
Right. I mean, we could just rewind right back to the beginning, right, and talk through many of the topics that we have, because you don't know exactly when things are going to turn, and valuations can matter over the long run, right? They don't matter. They don't always correlate in the short run because things can get out of hand with expansions, the multiple expansions. People are willing to pay more for things that have done well. But when it turns, it is painful. I remember working with clients in the 2000s period. It is difficult to remember that now, right? For many people, if you don't do it daily, it's really easy to ignore it. But if you're a retiree or if you're somebody thinking about retiring and you have what we see every day, much of their allocation is dominated by U.S. stocks, right? And U.S. growth in particular, it can be extremely dangerous. How are you going to feel if that is cut 30, 40%, 50% potentially, if it's a really bad scenario and you're looking to retire? How's that going to change that decision making? What if you're invested in a company stock specifically? Because we talk with more and more people, right, that are involved in that. It's exciting to think about how AI could change the world, right? But how much of an influence is that going to have? And then what competitors? We just saw this week, there's a potential competitor that could do it much cheaper. And that can, throw things into a crazy storm of people making changes based on that. So the diversification allows you to guard against the unforeseeable risk. And that is what we are trying to do for clients is to understand where they are in their financial strategy, right? And that's part of this 3-step process that we walk through. After we put together a financial plan, we're trying to go through these 3 steps. And it can sound basic at times, but when we're digging into a custom plan for you, a specific scenario to talk about the goals that you're trying to reach and when you're trying to get there, we want to make sure you have the resources to accomplish those things because that's what ultimately matters, right? Mike, I know you've dealt with a lot of these situations and talked through with many clients and some difficult situations as they're going through real tough decisions, right?
Oh, exactly. And I've always said my 25 years of investing experience, the best investments you'll ever make are the hardest ones. The ones you, at the time, you're like, why am I doing this? Why am I buying stocks when they're down 30%? Why am I buying international stocks right now? Those are the ones 5 to 10 years from now, you'd be like, I'm really glad I did that. The ones that looked easy, like, oh, wow, that was up to 30%. NVIDIA, it's going to go up another 30%, right, next week. Those are the ones like my Cisco Systems purchase or my WorldCom purchase in 1999. Those didn't work out too well. So the hardest purchases, the hardest ones are the best. But this is, our approach, and this is an evergreen slides for those who listened to previous webinars have watched this before. But we're short-term pessimists, and I'm quoting Morgan Housel here. The money you need in the next 5 to 7 years, we don't want in the stock market. That's where we have the bonds or some amount of cash. For that money you don't need in the next 7 years or so, we want for that growth because your longer-term risk is purchasing power or inflation, and having that and taking advantage of global growth with U.S. and international companies will let you help you offset that growth of costs over time. We can obviously implement the plan. That's what we do here every day in terms of the investments we select. And then probably the part where most people don't spend enough time on their own, which we are doing daily, is monitoring your investment portfolio. What we like to call opportunistic rebalancing. When the market goes down, like March 2020, 2022, we're going to be actively buying. The market gets really hot and maybe a little bit pricier, we're going to trim a little bit. So that's something that I think can add a lot of value to your investment results over the long term.
We talk about a lot of topics here on the podcast, right? We dig into tax planning on many of the episodes, retirement planning, making sure you have that steady paycheck in retirement. But really, there's so many other areas that we've handled and talked through in our 230 some episodes. So if you have questions to summarize on any of these things, you can reach out to your advisor at Financial Symmetry or one of us. We'd be happy to respond or feedback on the podcast in general. And then just follow us on YouTube because we're going to have more content there throughout the year on different deeper dives on specific topics and questions that we're receiving. So we appreciate you listening, and we'll talk to you again in 2 weeks.